Well, good afternoon. This is Chris Pike, and on behalf of everyone here at Private Client Group, we'd like to welcome you to our inaugural House View webinar series entitled Summer 2019. Where do we go from here? Now, we intend to update our clients on our house views on at least a quarterly basis or as conditions warrant. So with that, let's set the table for today's discussion. First, I'll provide a current assessment of the economy, capital markets, and the geopolitical backdrop. We'll then share our expectations for these topics. We'll also look for some ideas or share with you some ideas on portfolio positioning going forward. And then lastly, we'll allow some time for your questions. Before we go any further, some housekeeping. At the bottom of your screens, you're going to see three buttons: a Q&A button, a hand, and a text button. At any time during the presentation, you can type in a question, which we'll look to answer at the end of our prepared comments. Feel free to text me anytime during the presentation as well. And raise your hand if you have any issues technically with the system, and we'll look to get those sorted out. Okay, so let's begin. Here on slide 2, we outline the 6 areas of focus for today's conversation. The U.S. economy and capital markets are breaking all types of records. 2, soft landing, softer growth, or reacceleration. 3, domestic geopolitical and other risks create volatility and opportunities. 4, inflation is MIA, or deflation and rate cuts next. 5, be careful what you wish for. And then finally, 6, prepare for the next cycle. So let's talk about the U.S. economy and the capital markets here. You know, as we sit here today, the U.S. economy and capital markets are breaking all types of records. As an example, since the market bottom in March 2009, the S&P 500 has returned over 440%. That's about 27% per year on average. And while at the same time, the NASDAQ has returned over 530% in aggregate, or almost 30% annually. And to put this in perspective, ignoring the brief 4Q18 market tantrum, the S&P now remains in the longest bull market rally since the Great Depression. And come the end of July, the current expansion will be the longest on record. And the job market has been a driving force behind these trends, and depending on who you ask, it could very well be the best job market we've had in decades. The unemployment rate is currently 3.6%, the lowest since the 1970s. Unemployment claims have been trending at or around 215,000 to 220,000 for some time now. And finally, since the end of the last recession, the U.S. has added over 20 million jobs, bringing us to about 150 million jobs today. This is truly, truly astonishing. You know, so where do we go from here? You know, where are we in the current economic cycle, and what does the future hold? These are the questions that we get almost daily, asked daily from our clients. You know, is it weaker growth, the all-elusive soft landing, or is it a reacceleration in growth? So to answer this, let's take a closer look at what we call the anatomy of a life cycle, or an economic life cycle. You know, first you have troughs. Troughs are characterized by a resumption in economic activity, growth in credit and lending, as well as a bottom in rates and inflation. So we doubt, given where we sit today, that we're currently in an economic trough. Then you have expansions. Expansions are characterized by rising interest rates, meaningful growth in corporate profits, rising inflation, and increasing consumer and business sentiment. So given the current backdrop, we're rather certain we're no longer in the expansionary phase of the economy. So this leaves us either at an economic peak or in decline. And if we were peaking, we would be witnessing slowing top-line growth. We actually see that right now, so we can check that box. We also witness earnings growth slow and confidence peak, check. But inflation is already redlined, and credit spreads have already troughed. So as we sit here today, we observe the following. We see employment growth slowing. We see consumer and business sentiment rolling over. Modest, if not outright reversing wage growth. Falling business activity, weak housing trends, virtually no inflation, and dovish Fed speak. So in our opinion, the U.S. economy is clearly decelerating or in the declining phase of an economic life cycle. But the question still remains, where do we go from here? Is it the cataclysmic path that we followed in 2006 through 2008, when the U.S. economy lost over 8 million jobs, the credit market froze, and the housing market imploded? We think not. In our opinion, the underlying asset bubbles and excesses that are needed are just simply not present today. Further, while GDP growth is expected to be only roughly 2% in 2019 and 2020, the U.S. remains one of the most vibrant economies among all developed countries. So from our perspective, we're just simply slowing and believe the next downturn will be short and shallow. But there are risks, and some of them are more real than others, which leads us to our next topic. Risks create volatility and opportunity. Clearly there's no escaping the daily deluge of negative news flow, from Chinese tariffs and trade wars to saber rattling in Iran, to concerns over a hard Brexit. And this is not to mention the own political circus and economic uncertainty we face here in the United States. But while these events introduce volatility in the markets, they also present opportunity as asset values are re-rated, and in some cases on a daily basis. For example, despite the recent back and forth with us and China over tariffs, the Chinese stock market is actually up 25% year to date. And despite economic softness across the Eurozone, recent comments by the European Central Bank regarding rate policy has helped support European stocks. And finally, bonds or bond-like investments here in the U.S. have been one of the best allocations over the last 12 months, especially during the recent surge in global equity market volatility and reversing rates. There are other examples we can discuss, but I think the point is simple. We believe there are opportunities both here and abroad across both equity and fixed income. But a systemic concern we do have is inflation, or actually the lack thereof. And how will this ultimately impact the future path of our economy? With inflation MIA, are deflation and rate cuts next? While this is certainly a near-term positive for equities, we're not totally convinced it's a good long-term remedy for the markets or economy. This has been a talking point on every major financial news network and across the financial press for several weeks now. And make no mistake, trends are clearly slowing. Now, to this point, a couple of weeks back, one of our clients asked us, Chris, why do you believe the economy is slowing? What can you point to? So here on this slide are just a few answers to that. First, in the upper left, we have personal consumption expenditures, and this is the Fed's preferred inflation gauge. You can clearly see it hooking down. We also see the Purchasing Managers Index of prices paid for manufactured goods is also falling. And you have wages as measured by the Employment Cost Index, or ECI, and that too is hooking down. And finally, the 5-year forward break-even, a measure of inflation expectations or prospects 5 years in the future, is well below the highs of 3% set back in 2012 and 2013. And while the current expansion is almost 10 years old, it has been for the most part below trend. In previous recoveries, we've observed real GDP growth well above 5%, but not this time around. In fact, real GDP growth topped out back in the third quarter of 2014 and is now only expected to be roughly 2% in 2019 and 2020. Then, after considering the geopolitical risk we just spoke to, now you have an equity capital markets looking to the Federal Reserve to cut rates as a sort of insurance contract against slowing growth. To this extent, U.S. equities have already rallied between 8 and 10% since the end of May in hopes of a cut during the upcoming meetings in July, September, October, and or December. But, and I really need to emphasize the word but, we really need to be careful what we wish for. From our perspective, the markets are pricing in a 50 to 75 basis point cut in Fed funds. And quite frankly, we believe the Fed is setting themselves up to fail, a lose-lose situation, if you will. If the Fed doesn't cut, then the markets will sell off. And if the Fed does cut, then watch out below, because what does that really tell us about the economy? So here on slide 15, we put this all together. Much has been discussed in the financial press recently regarding the so-called inverted yield curve. And basically, that's just simply when short-term rates are higher than long-term rates. But when this happens, it's typically thought as a decisive indicator of, one, tightening financial conditions, but more importantly, a precursor to a recession. But as we illustrate above, it isn't until the Fed actually begins to cut rates, and that's the blue line, that equity capital markets acknowledges slower growth, sells off, and then soon after we enter a recession. So inverted yield curves by themselves are not the cause of a recession, but the combination of curve inversion and dovish monetary policy is something to be very wary of. So once again, be careful what you wish for. So finally, let's talk about what's next. Where do we go from here? What should we do in terms of preparing for the next cycle? So here on slide 17, we present our portfolio positioning ideas as of summer 2019. I know there's a lot to unpack, so let's take it slow. First, we continue to promote what we call a value tilt portfolio. That's a portfolio with a value bias constituted with securities and strategies that pay dividends, have attractive yields, and solid balance sheets, and trade at a discount to valuations. We like large caps as they offer liquidity, and when the market gets choppy, managers can sell only what they can, not what they want. We also like defensive over cyclicals at this point, at least in the near term. Globally, we prefer developed large caps, partly due to rate divergence between the U.S. and the rest of the world, but also because the Eurozone may be further down the deceleration curve and may be bottoming sooner. EM, or emerging markets, have had a great run since the beginning of the year, most likely pulled along by the resumption in the Chinese economy and stock market. But we wonder perhaps if it's time to move to the sidelines here. And then finally, we continue to like REITs in the near term and preferred equities. Together, these two asset classes form the base of what we coin a sleep well at night portfolio. Next, we highlight the trend in oil and therefore energy. Typically, when oil rolls over, it's a recession signal. And while there has been a bid for oil recently, this is more to do with saber-rattling Iran and supply versus increase in global growth and demand. At the same time, we see a bid for gold. And while some argue that cryptocurrencies are taking the place of gold as a haven reserve, we still, at least at this point, see no value in crypto. Ask yourself this: when was the last time you could actually pay your rent with Bitcoin? We've already discussed the thematic trade implications of today's market and the need to be tactical and nimble. So I'm really not going to rehash my thoughts on this topic. Munis, we've long heralded muni bonds as a core holding in a client's portfolio. In our opinion, muni bonds are enhanced cash positions with positive after-tax or tax-equivalent yields. And while this is especially true given the limitation in certain states with SALT deductions, we think it's a really, really strong asset class to be in right now. And unlike treasuries and governments, we just don't see the muni curve inverting. Also, as many of you know, we've long encouraged clients to primarily use whole life cash value and protection planning for death benefit, but the fixed income savings benefit are also attractive, especially during uncertain financial times. To us, cash value of whole life insurance acts similar to a bond portfolio, but it's just void of duration or credit risk. Next, avoid credit. We like investment grade or higher rated debt, but simply not junk. To us, this is like being a knife catcher in today's environment, trying to invest in credit. It's a great trick until you miss. Tips, we believe that tips or treasury inflation protected securities will remain challenged in the near term. And we have pointed out inflation prospects are moving only in one direction, and that's not higher. but this should be a trend worth watching into 2020. For if our thesis of a short and shallow trough comes to fruition, TIPS may offer a very attractive risk-return trade-off going forward. And finally, we believe the next chapter for investors is GARP investing, or growth at a reasonable price. Meaning we continue to expect downside, and equities will be led by technology, growth, and small caps, as well as sectors that are economically sensitive or cyclical. But once we see or observe a meaningful pullback in these areas, we believe it'll be time to step back in, tactically buy back into these sectors, sell down duration on fixed income, and invest in credit. Because if you remember our anatomy of an economic life cycle slide a couple back, during troughs is when credit expands, optimism increases, activity bottoms, and markets are poised to run. And we think that this could happen as soon as 2020. So I want to thank you for your time. And with that, we can open it up for questions.